In this video, we'll talk about accounting for equity transactions. We're just going to go through some examples. We'll talk about an equity issuance. We'll talk about treasury stock, which is when a company repurchases its own stock. We'll talk about how companies account for dividends. Dividends is when a company pays money to its stockholders. And finally, we'll talk about stock-based compensation. That's when a company compensates its employees using its own company's stock. Okay, and we're going to just imagine when we're doing these examples, we're going to imagine that we are a company called FactSet. And FactSet is a company that provides data and information to investors. So we'll just pretend we're FactSet as we go through these four different types of equity transactions. First, equity issuance. So let's imagine we're FactSet and we want to raise new money. Okay, we want to expand, we want to invest in something, so we need money. And we ask ourselves, should we raise money by borrowing money, or should we raise money by opening up our ownership to new investors? And equity issuance means that we're going to open up our ownership to new investors. We're actually going to sell ownership in the company. And how we do this is we create new shares of FactSet. So we have a certain amount of shares of FactSet, and if you own a share, that you own a percentage of FactSet. Well, we're going to create brand new shares and bring those into the equation. And now the pie is going to be bigger, and we're going to sell those new shares to new investors. Okay, that's the situation. And so FactSet is going to issue 1 million new shares to investors, and they're going to sell them for $100 each. So if you want a share of FactSet stock, you got to pay the company $100. And the second bullet point here gives you something called the par value. And I'm not going to emphasize the par value. It's really not an important item at all. It just is necessary in terms of how we record the journal entry when we sell common stock. Okay, so par value will be a very small part of what we talk about here. Okay, $100 each, 1 million shares. We're going to have proceeds to FactSet of $100 million. 1 million shares, $100 each, $100 million. That's going to be proceeds to FactSet. We're going to raise that money, and then we're going to use it to invest in new property or whatever we're going to do with those proceeds. Now, how do we record the journal entry? The answer is we need to use this par value, and we need to split up this $100 million into a par component and into a additional paid-in capital component, APIC component. Okay, and this is not important. This is just what companies do, and you need to know how it works just so you can interpret their balance sheet and their statement of stockholders' equity. So the par value for these 1 million shares, what you do is you just take the $1 per share and you multiply it by the 1 million shares. So this is just $1 times 1 million shares, okay? And that's how we get the par value of $1 million. APIC stands for additional paid-in capital, and what it means is it's just how much capital did you raise over and above par value. So it's additional paid-in capital. And since we put $1 million into the par value, we're going to have $99 million left, which we're going to put into APIC, or additional paid-in capital. And here's how the journal entry looks. So we're going to debit cash for $100 million because we're receiving $100 million in cash. Then we'll credit the common stock account. Okay, common stock is just a normal equity account. You'll see it in the equity section of the balance sheet. We're going to credit that account for the par value. And the par value was just $1 million. And then everything over and above par, we're going to credit the additional paid-in capital account, which is just another equity account in the equity section of the balance sheet. And that'll be credited for everything over and above par. Okay, so that in this case, it's $99 million. Now I'm going to show you what FactSet's, so this would be the journal entry for FactSet when they issue 1 million new shares at $100 each, and their par value is $1 per share. I'm going to show you their balance sheet real quick, and let me just tell you I was lying. FactSet's par value is actually 1 penny, but I just wanted to make the calculation a little bit easier, so I said it was $1. But let me show you what FactSet's balance sheet looks like. Here's what it looks like. It's FactSet's balance sheet, and this is the stockholders' equity section of the balance sheet. These numbers are in thousands, except for share data. So there's some share information in the caption of all these line items, and that's not in thousands, but the dollar values are in thousands. The first thing I want to show you is here's that common stock account. And remember, when we issue new stock, we credit the common stock account for the par value of that stock. And you can see that FactSet has a 1 penny par value. So I was lying about the dollar. They actually have a 1 penny par value. And just in terms of calculation, let me just show you this number here. This is a share number, okay? This is how many shares are issued. As of August 31st, 2019, FactSet has 40,104,192 shares that have been issued throughout the history of FactSet, okay? So that's how many shares are issued. So how much money would you expect to be shown on the balance sheet in the common stock account? Well, it would be the number of shares issued, 40.1 million, times the par value, which is 1 penny, and that equals 401, and that's in thousands, okay? So 401,000 is just the number of shares issued times the par value per share. Now, when FactSet sold these shares, they sold them for more than a penny per share. And for whatever amount of money that they were able to collect from new investors by selling those shares over and above a penny, well, that balance would go into the additional paid-in capital account, which, as you'll remember, we abbreviate that as APIC. Okay, so you'll see the common stock account having the par value, and then this is everything above par. And that's what we see on companies' balance sheets. Okay, the next type of transaction we're going to go through is how companies account for treasury stock. So treasury stock is when a company repurchases its own shares. So FactSet sold $1 million worth of 1 million shares into the market, okay, new investors. But now they're thinking, well, now we've got some extra money and there's nothing really good for us to invest in. You know, that we don't have any good investment projects to grow the company, right, to grow our operations. Instead, how about we just return it to investors, and we'll do it in terms of a repurchase. So we'll repurchase some of our own stock. So we sold you some shares in the past. Now we're going to buy those back. We're going to give you cash, and we're going to get those shares back into the company. So here's the situation. Suppose FactSet's going to repurchase 2 of those shares that are outstanding, and the market price has gone up. Remember when we sold them to the market at $100? Well, now to buy them back, we're going to have to pay investors $150 per share to buy those back. So here's the transaction when we do that. We're going to pay $300, 2 shares at $150 each. That's $300, a credit to cash. And the debit is going to be to an equity account called treasury stock. So at the same time we're decreasing our cash balance, we're also going to be decreasing our total equity balance. And we decrease equity with a debit. And it's into an account called treasury stock. So now we just have this stock that the company owns. The company owns its own stock. Okay, now we've got those 2 shares sitting in treasury. And what we could do, we could retire them and never use them again, or we could just resell them back out into the market. So suppose that the market price went from $150 now up to $200, and we want to resell one of those shares. Well, we'll get $200 into the door, right, in cash. And how we account for this resale is we reduce treasury stock for the cost basis. So what was the cost of those shares that we put into treasury stock? That's the same amount that we'll take out of treasury stock when we resell it. So remember, we repurchased those 2 shares at $150. So that was the cost basis of the shares. And when we resold 1 share back into the market, we had to take that $150 out of the treasury stock account, okay? But now you'll see that this journal entry isn't balancing. We need another credit. So one thing you could think, and this is wrong, but you could think that, well, let's just put a credit to a gain on the income statement, a gain of $50, because we were so smart that we made $50 investing in our own stock. Well, accounting rules don't allow us to do that, okay? We don't want our managers focused on trying to win in transactions with their own company stock. We don't want them speculating in their own company's stock. So rather than crediting a gain on the income statement, we're going to credit APIC. Okay? And you'll find that the APIC account within equity is just kind of a catch-all account that captures a lot of the bits and pieces of other transactions. And so when we made $200 from reselling this share, we took $150 out of treasury stock, and then we increased our APIC account by $50. Okay, we just have more paid-in capital than we used to. And finally, just for completeness, now let's resell that second share, but this time the stock price has gone back down to $100. So we bought it for $150, it's gone back down to $100. We'll debit cash for $100, that's how much money we're getting in. Now again, we're going to credit the cash basis or the cost basis out of the treasury stock account, because now we don't have any shares in that account anymore. So that account should be back at zero. And so it went up by 300, down by 150, down by another 150. Now it's back down to zero. And this time we need to balance the journal entry with the debit. And that debit again is just going to go to the APIC, additional paid in capital equity account, for $50. Okay, and now let me show you again FactSet's balance sheet. And all I want to show you is this treasury stock account. Okay, this treasury stock account is at cost. You see it says at cost there. And you can see that they have 1.986352 million shares sitting in that account. And this here, this balance, is the cost basis of those shares. So that's 433,799,000, since this number is in thousands. Okay, that's $433.7 million. And you'll see it also has brackets around it. It's negative. This is a debit balance. Okay, typical equity balances are credit balances, remember. So this is a credit balance. This is a credit balance. Right? But this treasury stock account is a debit balance. Let me just flash back to this journal entry. You see how we're creating a debit here? So this is a debit balance account, and that's why it shows up as negative on the balance sheet. Okay, that's what that looks like for treasury stock. Now we'll talk about dividends, and there's two events that are going to occur when FactSet wants to issue a dividend. Okay, so this is actually another way FactSet can transfer money from the business out to its investors. The first way was by repurchasing treasury shares. Okay, that took money out of the business and put it back out to investors. Another way is a dividend. So here we're not repurchasing any of our shares. We're just giving money out to our investors, right? And hopefully equally. So each investor gets a certain amount of money for however many shares that they have. And so this is just another way to distribute money to investors. And we're going to suppose that FactSet declares a total dividend of $1 million. And all they've done at this point is declare that it will occur. Okay, they haven't actually paid the dividend yet. So when the declaration occurs, we're going to debit retained earnings. Okay, we are reducing retained earnings. RE is just abbreviation for retained earnings, and we are reducing the retained earnings account. Why are we reducing retained earnings? Well, because we had net income, right? Net income increases retained earnings. Well, are we going to retain those earnings, or are we not going to retain those earnings? If you pay a dividend, you're not retaining those earnings, okay? So you bring retained earnings back down with a debit to that account, and you do that when you declare a dividend. Well, since you haven't paid it yet, you don't credit cash, you'll just credit a liability account. And here I'm calling it dividends payable for $1 million dividend. Now, when FactSet actually pays the dividend to investors, they'll debit that dividend payable account, reducing it back down to zero, and they'll credit cash because they're actually paying the dividend cash now. And that's pretty simple, okay? So accounting for dividends is a pretty simple task. Finally, we'll talk about stock-based compensation. So stock-based compensation is when a company compensates its employees with company stock. So we don't have enough money to pay you in cash. This will happen a lot at startups, right? Startups and tech companies and so on, and other companies as well. But companies that, hey, we don't really have enough cash to pay you cash, we're just going to pay you in ownership of the company, okay? And it also helps align the incentives of employees. So if I'm just paying you cash, well, maybe you'll do a bad job because you get the cash. If I pay you in stock, well, now you're trying to make the company succeed because you want your stock to be valuable. Okay, so sometimes companies will give stock-based compensation not only because they don't have the cash, but also because they want to align the incentives of their employees. And what they'll do is they'll grant the compensation to employees. And it can come in many different contract types. The two main ones are stock options, where an employee has the option to buy a share in the future for a certain amount of money, or restricted stock, when an employee just kind of earns shares over time and they just are given the shares. Okay, there's no option involved. You just get shares over time. But the task of the accounting department when this happens, okay, the company grants stock compensation to its employees. The accounting department needs to determine what is the value of that compensation, because that's an expense of the business, okay? So what is the value of the compensation you just granted to your employees? And so this is an estimate that the accounting department comes up with. They say, okay, you just granted a bunch of stock compensation to your employees. We plugged it into the Black-Scholes formula or some other compensation estimation formula, and we came up with $3 million. That's the value of the compensation you just granted. They also determine the vesting period. So vesting period determines how long does the company have to, how long does the employee have to sit in their chair and do their job until they earn the benefit of the stock compensation, okay? So here I'm granting you stock options, but you need to sit there and work for 3 years before you earn these options, okay? So you vest over 3 years. So these two items are important for the accounting department because what we're going to do is we're going to expense this value over this period of time, and we're just going to do it equally. So in each of these years, we're going to debit compensation expense for just 1/3 of the total fair value. So that over the 3-year vesting period, right, compensation expense in total over the 3-year vesting period will be $3 million in total. So we've expensed the entire value of what we have granted to employees over the vesting period. And that's the debit side of the journal entry, okay? And that debit side, actually shouldn't be an equity account, okay? So that's very important, and I'm glad I'm pointing this out. This is an income statement account, okay? You will see compensation expense on the income statement, okay? That is a cost of operating the business, and so it reduces operating performance of the business as shown to investors. So that compensation expense is an income statement account. It's an expense account, and we're debiting that account each year for just an equal fraction of the total fair value of the compensation. Okay, and the credit of this journal entry, again, is just going into this APIC account. So I said, remember before, the APIC account just kind of captures the bits and pieces of all these equity transactions. And so we'll credit the APIC account as we debit compensation expense. And if you just think about the total effect on stockholders' equity of each of these journal entries is 0, because we're debiting compensation expense, which is in the income statement. And remember, that'll get closed out to retained earnings at the end of each year. So it's going to reduce retained earnings, but then the credit to APIC is going to increase APIC, and there's no effect on stockholders' equity when we record this compensation expense. Okay, so those are the journal entries that we'll record in years 1, 2, and 3. Then the employee will finally vest in their compensation. And so let's go over the two main types of contracts that companies grant their employees. First is a stock option. Here an employee has the option to exercise for a certain strike price at a future date. And the employee would only do that if the stock price is higher than the strike price. Okay, so suppose the stock price is higher than the strike price. Like say it's $150 stock price, but the employee has the option to buy a share at $100. So they're going to exercise the option. They'll actually pay us. They'll pay FactSet money because we sell them the share. So they pay us the strike price of $100. And then what we do is we just say, well, that $100 we were paid by the employee, that's just the employee buying new shares in our company. So we're going to credit common stock and APIC just like we would with any other sale of a share of stock. Okay, so that's how we account for the stock option. Finally, how do we account for restricted stock? Restricted stock is just at the end of the vesting period, the employee just receives the share. Okay, there's no option or anything involved, you just receive the share. And so that's just a simple reclassification of a small par value amount between additional paid-in capital and common stock. So we just need to reflect the fact that this one share now becomes an issued share. And remember, we want our common stock account to reflect the par value of all of the shares that have been issued. And so we just transfer $1 from APIC into common stock because that was the par value. And that causes our common stock account to just hold the par value of all of the shares that have been issued in the lifetime of the company. Okay, so that is the end of how to account for stock-based compensation. So we've gone just through 4 different types of equity transactions. We talked about accounting for equity issuance. We talked about treasury stock or repurchasing your own stock, accounting for a dividend, which is giving money to equity investors, and stock-based compensation, which is compensating your employees with stock.